Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review where I talk about current events for the everyday investor and home buyer. Our topics for this week, first up from RNZ on the 12th of December, building cost inflation dropped to the lowest annual rate since 2015. Topic number 2 from Oneroof on the 12th of December, FOBO knocks Christchurch for 6. What is it and what's it doing to house prices? Topic number 3 from RNZ on the 12th of December. Smaller banks often match big bank interest rates, mortgage advisor. Topic number 4 from Oneroof on the 11th of December. Tony Alexander, don't bet on ultra low mortgage rates next year. Topic number 5 from Corelogic on the 12th of December. Best of the best 2024 unveils a year of contrasts. And this will be our last Week in Review podcast for 2024. So we'll look forward to seeing you in 2025. But let's kick this one off with a bang. And as you can see, if you're watching it on YouTube, I'd put a Christmassy background on for you. We don't really have a fire going behind. So topic number 1 from RNZ on the 12th of December, building cost inflation drops to the lowest annual rate since 2015. Building cost inflation in New Zealand has significantly slowed down, reaching its lowest point in nearly a decade. The annual inflation rate is now 1.5%, a stark contrast to the nearly 21% peak observed in 2022. Several factors have contributed to this decline, including stabilisation of supply chains. The disruptions experienced during the pandemic have eased, leading to a more predictable flow of building materials. Decreased demand for new houses. The number of building consents issued has fallen, reducing the pressure on construction companies and likely leading to lower profit margins to attract clients. Fluctuations in material costs. While prices for some materials like steel have fallen, others, like those used for exterior walls and ceilings, have increased. Experts suggest that while there's optimism for an uptick in building activity next year, the recent slight increase in the QV Cost Builder Index warrants some caution. This could be a sign of builders and contractors adjusting their pricing in anticipation of potential interest rate changes and increasing demand. Second topic for this week in review from Oneroof on the 12th of December, FOBO knocks Christchurch for a 6. What is it and what's it doing to house prices? Christchurch's housing market is experiencing a new trend called FOBO, which stands for fear of a better offer. This is distinct from FOMO, fear of missing out, or FOOP, fear of overpaying, although it shares similarities with the latter. This phenomenon has emerged in the past 3 months due to a surge in listings, providing buyers with a wider range of options. Harcourt's Grenadier, a real estate agency, has noted a 36% increase in listings year on year. This increased inventory is causing buyers to hesitate before making offers, as they worry that a more appealing property at a better price might become available. While properties are still selling, this hesitancy has led to a shift in market dynamics, with agents reporting that listings are outpacing sales. This is a notable departure from the usual pattern where sales either keep pace with or exceed listings. FOBO is particularly pronounced in the lower and middle segments of the market, where there are more comparable properties available. At the higher end, where properties are more unique and scarce, FOBO has less of an impact. Agents emphasise that in this environment, sellers need to be realistic about pricing to avoid their properties languishing on the market. Buyers are becoming more discerning, favouring properties that offer strong value and appeal. Properties with drawbacks, such as those located on busy roads or facing cladding issues, are proving more difficult to sell, as buyers have more alternatives to choose from. This FOBO phenomenon is not limited to Christchurch. Bailey's, another real estate agency, has observed a similar trend in Wellington, where buyer confidence is lagging behind seller confidence, particularly for properties in higher price ranges. My advice on this is, if you're interested in buying a property, put an offer in on it, because otherwise you'll end up missing out when the market does pick up again. So as long as it's in the right price point for you and you like the property, especially if you're a homeowner, if you like the property and it fits your price point, just take that plunge. I know it's scary, but you can do it. And if you're a property investor, buy based on the numbers and negotiate like the thunder. you might just get yourself a really good deal. Don't wait for a better one with a better asking price. Negotiate on the ones that you're interested in. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor and an experienced investor. And these events are available live, online, or in person, but not available until next year. We've just done our last one for 2024. Check out propertyapprentice.co.nz for upcoming dates in 2025 and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 3 from RNZ Herald on the 12th of December. Smaller banks often match big bank interest rates, mortgage advisor. While large banks often grab headlines with their advertised mortgage rate specials, smaller banks in New Zealand are frequently willing to match those rates. This creates competition in the mortgage market and can benefit borrowers who shop around. Mortgage advisors suggest that borrowers can often get smaller banks to match a competitor's rate, particularly those offered by the big banks. However, they may require evidence to verify the competing offer. While smaller banks add to the competitive landscape, they might not always match the lowest rates offered by even smaller specialised lenders, like ICBC and Bank of China, for example. Banking experts note that the major banks are unlikely to match rates from these specialised lenders unless the borrower is realistically likely to qualify for a loan with them. This is because these smaller institutions often have specific lending criteria and might not cater to a wide range of borrowers. The article also touches upon the potential trough of the interest rate cycle. ANZ economists predict further OCR cuts in 2025, but they believe that the markets have already factored these in. This means that the lowest point in the interest rate cycle might be approaching. Consequently, those considering locking in a longer-term fixed mortgage rate might not want to wait too long. While short-term fixed rates could decrease slightly, longer-term rates, 3, 4, and 5 years, might not drop further, especially with global long-term interest rates rising. The article suggests that a substantial portion of the decrease in interest rates from the peak to the current point has already occurred, and further reductions might be slower. There is even a possibility that mortgage rates for longer terms could increase slightly next year, influenced by recent rises in wholesale interest rates following the US presidential election. My thought on this is that wholesale rates or the long-term swap rates are they did show a bit of an uptick, but they now seem to be trending down again. So my pick on this is that interest rates, there is still potentially some room for them to move. So I certainly wouldn't be concerned if you're on a fixed rate for 6 months, for example. But we might be nearing the time where it would pay to look at some longer-term interest rates some stage next year. Topic number 4 from Oneroof on the 11th of December, Tony Alexander, don't bet on ultra-low mortgage rates next year. This analysis is provided by independent economist Tony Alexander. While the Reserve Bank of New Zealand has significantly cut the official cash rate, the OCR, in 2024 and is expected to further reduce it to around 3.5 by mid-2025, this doesn't necessarily guarantee ultra-low fixed mortgage rates. Fixed mortgage rates have already fallen in response to the OCR cuts, but further declines, especially for longer terms, may be limited. And longer term rates tend to be more affected by swap rates. For example, the 1-year fixed rate could drop to just above 5%, while 3 and 5-year rates might bottom out around 5.3%. It's important to remember that the current economic environment is different from the period between 2019 and 2022, when interest rates were unusually low due to factors like deflation fears and the global pandemic. Comparing current rates for those in 2017 to 2018, when the OCR was around 1.75, suggests that the potential for significant further decreases in fixed mortgage rates is limited. Despite the expectation of continued OCR cuts, the housing market upturn is likely to be more subdued compared to previous cycles. This is due to several factors. The bulk of the monetary policy easing intended by the Reserve Bank is already underway. Access to credit is more difficult due to stricter lending rules imposed by the Reserve Bank, such as the new debt-to-income ratio limits. The supply of new housing is much higher than in the past, with consent numbers remaining elevated even after the recent economic downturn. Rule changes are encouraging more land development and higher density housing, further impacting the supply and demand dynamics in the market. Considering these factors, house price growth over the next few years is likely to be in the 5 to 10% range annually, rather than the 10% plus often seen previously. However, the global economic and geopolitical landscape, along with unpredictable migration flows, could influence market behaviour in unexpected ways. Topic number 5 from Corelogic on the 12th of December, Best of the Best 2024 unveils a year of contrasts. The overview showed that the New Zealand property market in 2024 was characterised by a mix of resilience and divergence, following an initial upswing early in the year that gave way to renewed price declines and reduced market activity. Corelogic New Zealand Chief Property Economist Calvin Davidson described the market as being in a state of flux, with a nuanced picture emerging. The report underscores the varying performance across different regions, price segments, and property types, showcasing both opportunities and challenges within the market. Start price declines. After a brief period of growth in early 2024, influenced by post-election sentiment, property prices resumed a downward trend. This decline was primarily attributed to rising unemployment and delayed interest rate cuts. The Corelogic hedonic, I don't know how you pronounce that, hedonic. The Home Value Index, HVI, showed a 5% decline in national property values since February 2024. Auckland and Wellington experienced the most significant price drops, while Christchurch and Dunedin demonstrated greater resilience. Buyers market. The 2024 market favoured buyers with increased inventory, providing them with more negotiating power. First-time buyers took advantage of improved affordability, KiwiSaver withdrawals and low deposit lending options, making up a record 27 to 28% of all purchases. Conversely, mortgage advisors faced challenges due to high interest rates and low yields, resulting in reduced participation. Next up, luxury market dominance. Auckland continued to dominate the luxury property segment. 9 out of the top 10 most expensive suburbs were in Auckland, with Herne Bay retaining its top spot with a median value of $3.36 million. Arrowtown was the only non-Auckland suburb in the top 10, ranking 5th with a median value of $2.39 million. Regional growth centres. While most areas faced price declines, others exhibited strong growth, highlighting the market's regional divergence. Blaketown in the Grey District recorded the highest annual median growth value at 16.7%. Cobden, also in the Grey District, experienced the most substantial 5-year median value increase, surging by 108.8%. Rental yields. In Mataura and Southland, that offered the highest gross rental yield at 10.8%, followed by Wellington Central at 9.2%. These figures suggest that regional areas continue to provide attractive investment opportunities for landlords. In contrast, Whitford and Auckland recorded the lowest rental yield at 1.2%, reflecting subdued rental returns in high-value areas. Market activity disparity. Wallistown and Southland had the fastest moving market, with properties selling in just 7 days, indicating strong demand and limited supply. On the other end of the spectrum, Waimate recorded a median of 83 days on the market, highlighting a slower activity in some rural areas. Lastly, challenges in declining markets. Auckland Central experienced the most significant 5-year median value decline at 9.1%, while Mataura in the Gore District led the annual decline rate at -10%. These figures emphasise the challenges faced by certain areas in maintaining property values amidst market fluctuations. The outlook for 2025, despite the challenges of 2024, Calvin Davidson expressed cautious optimism for 2025, anticipating a period of modest recovery. This optimism is based on factors like inflation being under control and mortgage rates falling. He projected a potential 10% rise in sales volume and a 5% increase in property values, but cautioned that values would likely remain below the post-COVID peak. He attributed this to a build-up of listings that would continue to exert downward pressure on prices. Davidson also acknowledged potential risks to the market, including rising unemployment and the introduction of debt-to-income (DTI) restrictions. These factors could hinder the pace of recovery and limit borrowing capacity for some buyers. So key takeaways were the 2024 New Zealand property market presented a complex picture with contrasting trends. While some regions and segments thrived, others grappled with price declines and slow activity. The report suggests a shift towards a more balanced market with affordability improvements attracting first-time buyers while investors exercise caution. Looking ahead, while there are positive signs for a modest recovery in 2025, potential headwinds remain, highlighting the need for buyers and sellers to carefully navigate the evolving market dynamics. Are you ready to turn the tide in your favour and ride the wave of opportunity in the New Zealand property market? Register now for our free event called How to Succeed with Property Investing. These events are available both online and in person, although you're going to have to wait till 2025 for the next one. Whether you're a seasoned investor or just starting out, our free sessions will provide you with the essential tools and insights to make smarter, more informed decisions. Don't miss this opportunity to stay ahead of the curve and take the next step towards achieving your financial goals. In our free events, I'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up for one of our free events. If you've already been to one of our events and would like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through the website. So I just want to wish you all a very Merry Christmas and a Happy New Year, and we'll look forward to picking up these podcasts again in 2025, along with our free events. Thanks for listening, everyone. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.